Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills this morning. Let's get to the three things that you need to know today.
First up, U.S. stock futures sharply lower this morning as the fallout from President Trump's tariffs continues. The president remaining firm on his plans and comments over the weekend, saying markets may have to take medicine amid the tariff-induced hit. Meantime, strategists across Wall Street slashing their year-end targets for the S&P 500, with analysts from Oppenheimer, Morgan Stanley, Evercore ISI, Goldman, and SocGen all cutting their forecasts in recent days.
Plus, economists now boosting the odds of a recession. This year, Goldman Sachs and JP Morgan warning on risk of an economic slowdown, but Treasury Secretary Scott Bessent is rejecting the idea of a recession, telling NBC's Meet the Press that there is no reason to price one in. However, traders are boosting bets of Fed intervention, with markets fully pricing in 5 interest rate cuts this year and a 40% chance of emergency cuts in the coming weeks.
And Jamie Dimon out with his annual letter to shareholders this morning, urging for a quick resolution to President Trump's tariffs plans while warning on fragmentation of our long-term economic alliances. The JP Morgan CEO writing, the quicker the issue is resolved, the better, because some of the negative effects increase cumulatively over time and would be hard to reverse. The letter marking Dimon's first public commentary on the measure since they were announced, and this also comes ahead of big bank earnings kicking off this Friday.
U.S. stock futures falling this morning as the sell-off enters a third day after wiping out $9.5 trillion in value from global equities. The S&P 500 facing growing risk of entering a bear market as tariffs roil markets, prompting a slew of strategists to cut year-end targets. Joining us now with what investors need to know to kick off the trading day, we've got Yahoo Finance executive editor Brian Sozzi. We've also got here joining for the chat, markets reporter Josh Schaefer here. So, once again here, we're seeing markets continue, at least pre-market, to try and get an idea of what could play out this week as even more of the turmoil is anticipated. Taking a look at the futures here this morning.
Yeah, Brett, I mean, you go through the weekend and I just don't think anything really changed, right? If anything, if I was an investor and I thought maybe I'd get some sort of incremental news on the administration backing off these tariffs, I maybe feel less confident now on Monday morning than I felt going into the weekend. And so when you think about the narrative going into the weekend as we were selling off last week, it was, all right, I want to hear something either from the administration that means we're going to see less tariffs than we see right now, or I want to hear something from the Federal Reserve that's going to make me feel more confident about the state of the economy. You are not seeing either of those puts in this market right now, and that is what investors are looking for. And I think broadly across Wall Street strategists right now, the argument is until one side makes a move here, they just see the S&P 500 and stocks more broadly continuing to go lower.
You've heard squat, Josh. So you heard an administration across the board come here and dig in. And I know we're all looking here for playbooks and what to do. And I've been up for the past 7 hours ingesting recession notes, price target cuts like Josh mentioned. I talked to Judy Shelton, former Fed nominee, this morning on the Opening Bid podcast. Everything I heard, it's this comment from Wedbush analyst Dan Ives via email I just got. He says, Brian, where's the E? Everybody's looking for what earnings will be over the next year, and nobody can really figure this out. And until you can get a sense of what earnings will be for corporate America, especially the Magnificent Seven that is the driver of this market historically, you cannot necessarily come in here and buy this dip with any sense of confidence. So I look at what Amazon, a couple days ago, or I say 2 days ago, Eric Sheridan over at Goldman Sachs, really enjoy his work, said Amazon could see a $5 billion to $10 billion operating hit to its operating profits because of Trump tariffs. $10 billion. Yeah. That's huge. That's not chump change, as you would say. And, I have a good chart here from Charlie Bello over at Creative Planning. Look at these PE ratios across the board for the Mag 7. I mean, they have really, really compressed since the start of the year, in large part because investors are trying to figure out what the future earnings for companies will be. And as you sit here on Monday morning, can't figure that out at all.
We can't figure it out, and we should mention, just to contextualize the sell-off that I know we were all talking about this weekend, one of these moments where the stock market breaks the fourth wall and people you never hear talking about it are talking about it because they're terrified about their 401ks. The S&P 500 is currently on track for one of its worst three-day stretches on record. We have the potential for the S&P 500 to open in a bear market this morning, and here we have that chart that you were talking about.
Yeah, some of the biggest multiple compressions, and I have a story going up shortly on yahoofinance.com digging into this a little bit more. Tesla, Nvidia, Apple, these have been the biggest market drivers over the past 1 year, 2 years, 3 years, 4 years, 5 years across the board. If these stocks are not going to work because nobody knows how much they're going to earn, it's hard to come in here and buy not only these names on this dip, but the other 493 names in the S&P 500.
You could say that about the broad index,
Absolutely.
right? Two sides, right? We're talking about the PE for the S&P 500 coming down. You'll hear people talk about maybe stocks getting cheaper right now. Well, the E just hasn't come down yet, right? We haven't sort of figured out what the overall earnings are going to be for the S&P 500 as you bring those earnings estimates actually down.
They're still looking for growth.
Over the next
earnings,
right.
10% growth this year. Good luck achieving that.
It's going to come down, right? And the real question is just how much does it come down and how quickly, and how do companies figure that out? And again, circling back to the start of this conversation here, when the numbers just feel like they're sort of made out of thin air and they might move again tomorrow, if you're a management company, I don't know how you really deal with that, right?
Well, that's why at the beginning of the year, too, you typically have that reset where companies will come out and give what is largely, at that point in time, seen as their worst case scenario. That is the marker that is so easy for them to commit to that they could soar above that potentially, or even if they just come in at the same year over year type of growth expectations, that the market will have relief by the numbers that they're putting forward. Here are the real numbers that were anticipated at least for Q1 of 2025, as we're going to start to get those reports this week. 7% is what FactSet is looking for. If that is the actual growth rate for the quarter, it's going to mark the 7th straight quarter of year-over-year earnings growth reported by the index. Here's the larger thing to consider, though. How many of these companies have to come out once again and revise and put even more caution into what they're forecasting for the year?
And how much uncertainty is going to continue to plague the market moving forward? I also just want to mention some of the reaction that we've gotten across Wall Street here. The likes of individuals who have previously been very supportive of this administration now capitulating. You have Bill Ackman saying tariffs are destroying U.S. credibility. Stanley Druckenmiller saying that he is opposed to tariffs of over 10%. Again, a rare message from him. You also had Jamie Dimon warning in his annual letter about risks to long-term economic alliances. And interestingly, we're continuing to see yields moving this morning here. And now that's the quote from Bill Ackman here, in the process of destroying confidence in our country.
And the other thing of this, I'm glad you brought up Bill Ackman, because he also put out there on X, he thinks we are headed to a self-induced economic nuclear winter. And I think that's a reckless comment from Bill Ackman, to your point, who has supported President Trump. What, you thought none of this was going to happen? And now the market's under severe pressure and his investments are under a lot of pressure. He's going to come out and put this garbage out on X. He backed Trump, okay? Bill Ackman should know better. He should have saw a lot of these things coming. And to go out there and call for an economic nuclear winter, what does that even mean?
Well,
what does that mean?
And can I ask
totally
you about
reckless.
this, actually, because you talked to Judy Shelton this morning,
Yes.
a huge supporter of the president, supportive of his tariffs. Is there any capitulation from the Washington side at this moment?
I would say Judy is also dug in. And I think she echoes a lot of the folks in the Trump camp that this needed to be done to rebuild America. But she did acknowledge there will be short-term impacts on the economy and inflation.
Why do you think all of them wanted Trump to be in the White House? Why do you think that
Tax cuts.
Well, it was tax cuts, but it's having someone who they thought would be easier to get their agenda through. And now that they're seeing their person who they put into the White House and put so many millions of dollars around. If you're Elon Musk, oh yeah, what's Tesla doing here this morning? If you're looking at all of the pullback and what their reaction and their sentiment has been, it's because they're realizing, hey, maybe he's not actually going to listen to us in the near term and listen to how much this is going to impact our investments and our businesses. And oh yeah, then you get to the point where, oh man, we never thought he would do this. It's happening right now. And you know what? As you were talking about who's talking about this over the weekend, it's international too. I just got back off of a flight from France from 8 hours yesterday just to get back here to this set. And one of the huge things that really struck a chord with me is you couldn't go anywhere without some type of, and of course in France they're always going to be like, les dames américaines. But at the same time, one of the huge things that struck my attention, a server knew that I was American. He sat down, wanted to have a conversation with me and ask what I thought about the tariffs that were at that point rolling out. I'm sitting there trying to have dinner, but it's Liberation Day for America, and so he wants to know what's going on in the mind of America.
Brad, that is awesome insight, and that brings up what you've been covering, Josh, too. I wonder if we're just at the tip of the iceberg on these S&P 500 price target cuts.
I definitely think there's more to come, Saz. We got plenty of people that are still calling for essentially a 30% rally in the S&P 500 in this one.
Where are they?
Feels a little crazy to go to 6,700, doesn't it?
All right, guys, we got to go. Thank you so much for joining us, Josh and Sazi. Really appreciate it. Well, steady deterioration in U.S. stocks has prompted growing calls from Wall Street that tariffs could tip the U.S. into a recession. Goldman Sachs on Sunday raising odds of a U.S. recession to 45%, the second time it boosted its forecast in a week. Joining us now, Julia Coronado, Macro Policy Perspectives president and founder, and Steve Clemens, the Washington Note founding editor as well. Thank you both for being here. Julia, I want to start with you. Why are your odds of a recession only at 40% at this point?
They are not. We actually put on a recession call last week before the market meltdown on the tariffs that we calculate to bring a weighted average tariff on imports to 25%, which is even exceeding the Smoot-Hawley levels of 1930. So that's key factor number one. But it's an interaction of a lot of things, actually. The DOGE cuts not just to federal employment, but to government contracts across many sectors across the world, really injects a degree of uncertainty to the U.S. as a counterparty, to various sectors, companies, organizations, institutions making plans. We think that's going to put a chill on hiring. The negative wealth effect that we're going to see, and I agree, I don't think that this is over. And the draconian immigration policies, immigration has been a huge tailwind. So it's a multiple factors. These are all policy choices intended to be disruptive, but almost all of them are growth negative. So we do expect a recession to begin in the second half of this year.
And so, Steve, want to get your reaction to what's played out thus far, whether that be the market reaction or whether that be what comes next, because it seems like that's what everyone is trying to get ahead of right now. What retaliatory looks like as that's ingested over the coming days and weeks?
Well, listen, I've listened to a lot of your show this morning to various people that are blaming those captains of industry and finance who supported Donald Trump there, and they're now saying, oh my gosh, he may be having huge impacts. Listen, I don't think many of the people who supported President Trump knew that his team would do something as reckless as has happened now. And I didn't expect the president. I looked at how the president managed tariffs the first time around, and he had essentially what looked like a great label on tariffs, but he had a team that was highly sophisticated, that turned that tariff experience into a surgical one, that was very aware of things like market share and supply chain, and was able to kind of manage these issues. Peter Navarro, the president's advisor, has no interest in sophisticated approaches or surgical approaches. And they are wrecking. It's remarkable to the rest of the world that the president of the United States is wrecking his own economy, creating his own recession. It's like the king of the hill kicking down his own hill. And so, yes, a lot of people are extremely frustrated with the president and looking at what's going to happen. So, yes, there's going to be retaliatory rounds because they don't have a choice with their democracies in most cases, in many cases. And not in China's case, we'll put that on the table, but they're going to retaliate. They're going to protect their industry, and we're going to have a vicious cycle down as opposed to a reinforcing cycle up that's based on trust and confidence in the future. And I'll say something about President Trump right now. Political power is a lot like the stock market. Power is based on future expectations. Right now, future expectations of the U.S. market, and I would put Donald Trump in this, are just nosediving right now.
Julia, let me go back to you because investors are obviously concerned about that recession that you mentioned coming in the second half of this year. What are you telling clients who are freaking out in this moment about what they should be doing right now and how they should be thinking about the macro backdrop?
Well, the way we serve our clients is presenting the economic realities and forces that are shaping the economy. They're the ones that decide how to manage their assets. I will say, though, one of our notes of caution is that the Federal Reserve doesn't have the same ability to provide insurance the way it has in the past couple of cycles, even in the GFC. We are looking at an inflationary shock at a time when the Fed is still above its 2% target. We just heard from Chair Powell on Friday that, look, we see risks to both sides of our mandates. The ultimate responsibility of the Fed is to be the adult in the room. And right now that means being patient and letting some of this play out. And if there's a stock market correction because earnings expectations were unrealistic in a world characterized by a trade war, then so be it. The Fed doesn't have the ability to just step in and catch the falling knife here because this is an inflationary policy. So that's a note of caution that we urge our clients to keep in mind, because every time the market corrects, there's rumors swirling that the Fed's going to come in and cut rates, and President Trump is calling on the Fed to come in and cut rates. And by the way, that may not be the antidote you think it is. If we are in a world where the U.S. is proving to be the most unreliable partner from a security perspective, from a trading perspective, we're seeing real questions and sort of nervousness around the dollar itself. So that could bring a second round of inflationary impulses. We're in an extraordinarily difficult and dangerous situation where there's not an easy policy solution when policy itself is the problem.
Julia, this question to you, and Steve, I'll allow you to answer as well. As we think about the business leaders that we were just talking about, perhaps getting caught off guard and perhaps it impacting to a greater extent than anticipated some of their own outlook about business, to what extent do you believe that flows through and impacts two of the measures that the Fed is tracking up against most notably, and one of the measures that they have the most control over in those business leaders, and that is employment? Do we see such a deterioration in employment that the Fed has to make an unexpected move or more moves than anticipated?
I mean, we do expect that the labor market will cool off in the coming months. Again, the U.S. economy is an ocean liner. It is the largest, most diversified economy on the planet. So tipping it over takes an extraordinary set of circumstances. So we just saw with the jobs report last week that, still looks okay. Now, there's a number of reasons that warm weather and the lack of the federal firings showing up, that it may have come in above expectations. But it's a good reminder that, look, the U.S. economy demonstrates resilience beyond expectations again and again. So right now, and this is, again, another reason for Fed caution, we do see resilience in hiring so far. But ultimately, that's going to be the proof of the pudding, because recessions are defined by job losses. And when and whether and to what extent we see companies really retrenching on hiring is going to be the test of the economy.
Yeah, Steve, wanted to let you comment on that.
Just real quick. What you see right now is anxiety dramatically increasing in the U.S. economy around firms and businesses. When anxiety increases, they basically freeze up. They become paralyzed. They're going to stop hiring. They're going to shed workers. And so maybe that does force the hand of the Fed to do something. But how remarkable is it that the Fed, looking not at underlying economic drivers, but looking at the White House in terms of what it's doing, that this was, this was an act that was avoidable. When you look at all of the steps the Fed has taken to give a soft landing, to avoid a recession, and in one fell swoop, everyone's revising their estimates right now to build in, just as Julia said, the likelihood of a recession because of the policies we're seeing. It's a remarkable moment in history. This will be a moment that we will remember for decades as being one of those moments that is very, very hard to explain in how much wealth destruction in the United States, and as Bill Ackman and others have said, the status of the United States was sort of kicked over the hill overnight.
I think the hope is that it is something that doesn't take decades to recover from as well here, especially considering the very folks that you mentioned who are tracking their accounts here today, tuning into Yahoo Finance and trying to figure out their next trade decisions as well. Julia and Steve, thanks so much for taking the time.
Thank you.
Pleasure.
Coming up on Morning Brief, we count you down to the opening bell on Wall Street as stocks are set to open in the red. Sell-off continues. We'll discuss that and much more on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. And for more, this morning, we're taking a look at two members of the Magnificent Seven. We've got Tesla and Apple, and big news from discount airline Spirit. First up, Tesla shares moving to the downside pre-market, hitting a low of $214, a level below what Commerce Secretary Howard Lutnick predicted last month. And shares of the automaker would never reach again. Is that That was his expectation. It comes as one of Wall Street's biggest Tesla bulls. Dan Ives lowered his price target for the stock from $550 to $315 a share. He cited concerns about Tesla's exposure to China, calling it President Trump's tariffs an economic Armageddon. Ives also addressed concerns about Tesla CEO Elon Musk's work in the Trump administration in our show on Friday.
This is a fork in the road for Musk when it comes to Tesla. He either leaves Doge, takes a huge step back, or this will be, I think, some pretty dark times.
And so as we're taking a look at shares of Tesla here pre-market, they are still sliding by about 6.8%. Add that onto the slippage that we've seen over the course of this year. Year to date, the stock right now is down, and that's by about 37%.
I think the context of Dan Ives is important here, too. Yeah. This is one of Wall Street's biggest bulls. He's an amazing guy. He's a huge optimist. He's had a buy rating on Tesla and outperform forever. And so for him to come out and slash his price target by such a striking degree is a really important kind of look at the sea change that we are seeing in this moment and the degree to which so many analysts across the street are having to rush to update their price targets, both in terms of individual names and also the major averages, because we had an unintended policy shock that Wall Street's best were not anticipating. And if they did anticipate these tariffs, they anticipated getting sweeteners through tax cuts first. We didn't see that, and therefore we're seeing a lot of negativity on individual names. Tesla, the biggest laggard in the Mag 7 this morning. All right, next up, Apple also getting a price target cut from Wedbush Securities due to tariff concerns, down to $250 from $325. Dan Ives again writing, quote, no U.S. tech company is more negatively impacted by these tariffs than Apple. Ives anticipating iPhone prices could reach as high as $3,500 if the tech company shifted production to the U.S. Apple also awaiting a final ruling from the European Commission on allegations that the company had violated the EU's Digital Markets Act. Those shares down about 3.5%. If we can pull up a longer-term chart on Apple, you can see just the degree of selling that we have seen in this name since the tariffs took effect. It's down 24% year to date, and you can see the biggest drop obviously happening here in April after that April 2nd so-called Liberation Day announcement. I had sources telling me all last week that they were buyers of dips in some of the Magnificent Seven names, but none of them would touch Apple just because of the degree of exposure. And I think it's important to note that Apple has already made moves to get around tariffs from the Trump administration the first time around. And that clearly is not going to be a winning strategy this time due to the degree and widespread nature of these tariffs across various countries.
Yeah, we've seen the EU have a propensity to go after U.S. companies and using the Digital Markets Act as one of their reasons. And some of the largest fines that we've seen imposed to U.S. tech companies have been from the European Union. And so one of the major things tracking going forward from here is, to your point, as how Apple is kind of navigating what some of the larger concerns on trade are, where they are able to more swiftly move some of those operations. But then in addition, it's also a fold of how they're going to continue to monitor some of the changes in how they are going to be facing more competitive scrutiny going forward from here, given the larger operating system duopoly that has existed in the world to this point, essentially, especially in the US, between Android and Apple operating system. And so now some of that's starting to be decentralized is certainly going to impact the stickiness of the business overall. Yeah. And then largely here, we're also tracking the other airline story that we were tracking this morning. CEO of Spirit Airlines, Ted Christie, stepping down. The company confirmed the company's CFO, COO, and general counsel will be responsible for the temporary office of the CEO while the board searches for a permanent replacement. The leadership change comes weeks after Spirit Airlines exited bankruptcy protection in March. Now private, both Frontier Airline and JetBlue attempted to make deals to acquire Spirit, but those efforts were unsuccessful here. Of course, continuing to track what this means for the ultra-low-cost carriers more broadly, as Spirit in itself has been embattled for years. You look at the NPS score for how the airline has been able to ultimately try and maintain consumers and continue to have more positive a type of fanfare around them than detractors to the overall brand, and that has been unsuccessful. You looked at the deal that was set to go through. That was unsuccessful and essentially was seen as the only way forward for them to combine with another low-cost carrier in order to make sure that they could increase the fleet, make sure that at the same time that they're going after the same consumer that is opting for more premium experiences, that they're then creating even more of those touch points, which that wasn't going to be a fast type of capital expenditure and investment strategy time frame. And so all of these things considered, a new person at the helm of the company, perhaps a fresh take. We'll see exactly who gets selected for that position, though.
It's a tough time to be an airline name and a consumer-facing name at that. We've seen a slew of price target downgrades on all of the airlines across the board, really, given the negative impact we're expecting to see on consumer spending due to these tariffs. And airlines, of course, are not excluded from that. It will be interesting if we see kind of a bump in any sort of discounted retailers, but we continue to hear sources saying that travel is going to be under pressure. Of course, we'll hear more heading into airline earnings in a few weeks. Coming up, the opening bell on Wall Street. Stick around.
There you're taking a look at the opening bell on Wall Street at the New York Stock Exchange as Travelers Institute rings the opening bell. And at the NASDAQ, you've got Dollar Tree. Wow. Squad deep with the green. My goodness, they hit the branding elements perfectly in the entire color code for the team there, Dollar Tree, with the green jackets there, and some funfetti fittingly also in green. All right, taking a look at how the markets open on the day to begin today's trading activity. We're going to take a quick glance at the Dow Jones Industrial Average right now, opening the day down by about 3%. And here's the context coming in to today's trade. As you're taking a look at some of the slippage over the past, we'll put this on the 4-day view here just to populate this chart for you. We are down 11.5% over the past 4 trading sessions here. And even as we've got some movement around on this markets board, as I want to get the NASDAQ composite back up on this screen here as things are jumping around. Let me just take a look at, okay, somebody is in there. The gremlins of the Wi-Fi Interactive are at play here this morning. For much more on today's early trading activity, let's get on over to Yahoo Finance's Jared Blickery, who might have a little bit more luck. Jared.
Sometimes the ghost in the machine is trying to send us a message. So let's see if I can wrangle the Wi-Fi Interactive. And I think it gets a little bit behind when we got all those quotes coming in. And there are a lot of quotes updating. Here is the VIX. I'm actually going to get to that, but I want to start out the S&P 500. I need to show you a 6-month chart so I can show you the highs that we had from last year that are now in sight as a potential support, which would coincide with the level at which the S&P 500 enters a bear market. That level, basically 4,800 to 5,000. The exact bear market level is 4915.32. So we'll have to see what's in play here. I'd be surprised if we don't hit that, but it's possible that we don't. And here's that 6-month chart. Looks like we need a year. But just thinking about the markets and just thinking about the markets in general, I'm going to avoid the longer term charts and see if I can get a VIX. Here's the VIX. It touched 60, so right now it's just under 50. It touched 60, and you can't tell it here because this isn't showing the intraday, but intraday over in August, we did touch above that, and so this is quite the setup for the VIX. As I've been saying, the VIX has been trading a little bit differently than some of the other markets, and then some of the ways that it has historically. It's been comfortable at these elevated levels in a way that it hasn't in the past. And so that just kind of illustrates that we've had a new playbook over the last month or so. Here's the NASDAQ 100. Why don't we just stick here because the touch seems a little bit stable. Apple down 5.8%, Nvidia down another 7%, Meta down 4%, Amazon down 4%. Lots of dark red on this board, and this is just one day. If I punch up the sector action, you can see tech here. Tech is the worst off, down 3.9%. Consumer discretionary right behind it, energy right behind that. So the mega caps really leading things down. But let me show you the year to date, see if that punches up real quick, because tech is down 25%. That's not even off of the highs. That's just since the start of the year. Consumer discretionary also down more than 20% since the beginning of the year. Nothing in the green right now, not even the defensive sectors of staples, utilities, healthcare, and real estate. So everything kind of flashing these bearish warning signals, and we are in the midst of it right now. now. I want to show you our leaderboard, and I'll go back to an intraday view. ITA is standing out to me. Now, I don't talk about this a lot. It's an aerospace and defense stock ETF, and it was recently touching new highs as the rest of the market was under pressure. It has finally capitulated. Look at this dump right here. That is significant. That's showing that even the residual winners have turned into losers now. It is now down for the year, down 0.5%, so giving up all those gains since the beginning of the year. We can also see some of the carnage happening in futures markets, and what might be a good thing for energy prices, crude oil has been plummeting. I think it hit below 60. You can see it's at 60.27 now. It doesn't look like it's stopping anytime soon. I'll put a 5-year chart on so you can see the last time we were at these levels basically was in 2021, so huge distribution there in crude oil, and even in gold, which was touching record highs recently. Now that is up 18 basis points. It did dip below 3,000. I'll show you the 2-day price action so you can see gold has been kind of volatile as well. There we got that dip and then bounce up, so it is above 3,040 right now. And I think I'm going to leave us on Bitcoin because Bitcoin has been capitulating as well. It finally broke multi-month support and it touched just below 75,000 and rose a little bit. If anybody remembers some of my commentary from the afternoon shows going back a few months, I was looking for 72,000 thereabouts, and that would be the old highs. Almost touched those. So Bitcoin almost at a very natural place where it would stop. But as much as it's a leader, we might think of it as a bellwether. So honestly, I'm looking at Bitcoin here to kind of lead the way higher or lower. Back to you guys.
Jared, thank you so much. It's time now for today's strategy session. The flight to safety in full strain on Wall Street amid President Trump's tariffs. Just want to emphasize that if the S&P 500 closes at current levels, the S&P will officially be in a bear market. This is the second fastest plunge of the last 14 bear markets since 1945. So seeing just a hugely large sell-off in stocks here. I also want to mention we're seeing Treasury yields moving to the upside here, a bit of a sell-off in Treasuries as well. So we're going to talk about what that tells us about how the bond market is viewing the macroeconomic backdrop. Here with us now, we've got Chris Brigatti. He is SWBC CIO, and Luis Alvarado, Wells Fargo Investment Institute Global Fixed Income Strategist. Luis, I got to start with you. What are we seeing in bonds right now? What is this telling us?
Yeah, bonds are pretty much a flight to safety, perceived safe haven. All this volatility in the equity markets is causing fixed income markets to perform well as investors move money away from equities and into high quality fixed income.
But why are yields up this morning? Why is the 10-year up 8 basis points right now?
Yeah, I would say yields are just a function of kind of the technicals, right? Investors moving money in and out. I don't take this immediate reaction. There's still plenty of trading during the day. And I think the story remains the same, right? The uncertainty around growth and uncertainty around inflation, uncertainty on what the Fed is going to be doing is causing investors to reshuffle money around. So not really concerned. Overall, yields have come down from the peaks that we got back in January and February. You're starting to see it down. And it's mostly obviously a reflection of investors kind of recalibrating those expectations.
Chris, what's the rule of thumb and the keys to asset allocation in turmoil like this?
Not to panic. You got to be really careful and really thoughtful about what you're trying to accomplish and keep the long-term perspective in play. And you should never get overreactive, positively or negatively, and just stay the course, so to speak, and be thoughtful about how you're going to proceed going forward.
And so when we talk about that course, I mean, your percentages of your portfolio that you should be making sure that you've got safe haven exposure while either maintaining long-term risk? I don't know, because that's what so many investors right now, when they're waking up this morning or having the brunch conversations with Maddie over the weekend, they're trying to figure out what is that good balance for me at this point where many people are clearly rebalancing.
You know, it's really tough for every individual to really define where they need to be, but the overall thought process and some of the conversations I've had lately have been along the lines of, should people be less involved in the equity market that they had been? They might have gotten overexposed because they were so happy with the returns. You know, 25+% returns 2 years in a row tends to draw people in. And I think that is part of the reasons why we're seeing some of the backtracking we are. People were overexposed, and a more balanced portfolio helps. And we're seeing that with what's happened in the bond market in the past few days as well.
Well, let's go back to you, Luis, on the bond market here. One of the things I'm wondering about is the degree to which the front end of the yield curve is yelling at central banks for help right now versus the longer end being a little bit more focused on the deficit. Can you talk to me about how the movement across the curve and a little bit of that 2s10 steepener that we've seen globally, what that message is signaling about the risks of policy right now?
Yeah, of course. The very short end of the curve is actually, flashing to the Fed that they need some help. We heard from Chair Powell on Friday, unfortunately, that the bar to cut interest rates further is quite high, right? He wants to see some of that hard data, translating from the soft data, hard data suffering, and he wants to see something on the unemployment rate, something on the inflation front. I know that some investors are probably kind of yelling out for the Fed to do more, to act more soon, but we don't think the Fed is going to do that. They're going to go ahead and wait. They're going to take a more pause measure and see how the situation continues to unfold before acting. On the long end of the curve, right, that's pretty much real rates coming down, the whole growth story moving, because a lot of Wall Street strategists coming into the year had a very good growth expectation, but now they have to recalibrate that growth. They're making some changes into first quarter, second quarter GDP. Some other strategies going all the way to the recession. We're not in that camp yet. We think that the economy has a good chance to recover in the second half, but that's definitely going to create some volatility. But again, the steepener that you've seen, to your point, between the 10s and 2s, obviously as the short end of the curve continues to fall more aggressively, kind of trying to push the Fed into some sort of reaction in the upcoming meetings.
Can it push the Fed into a reaction? As you know, the market's currently pricing in 5 rate cuts and an increased chance of a mid-meeting rate cut as well. I mean, can the bond vigilantes really get that done?
I doubt it. To be honest, I doubt it. We see a Fed that is going to be more cautious. It's going to be a Fed that's going to wait and see until this policies translate into sort of like economic evidence that something is happening, not just because equity markets sell off. We saw a really strong Chair Powell on Friday kind of pushing back on that idea that the Fed is not going to come to rescue the market by any time soon. They're going to wait and see until something really translates into the economy before acting. So I highly doubt it that they're going to go ahead and act as aggressive as Fed funds futures usually price in.
Chris, as we kind of put a pin in this, what is the best way to anticipate how the Fed, who was anticipated at one point to only have 2 cuts on the back half of this year, that is now anticipated to have 5 potential cuts this year, what is the best way to, in your portfolio, anticipate what the Fed might do in reaction to data, a data-dependent Fed that they have continued to pound the pavement saying that they are going to be? How can they make sure or how can investors make sure that they're not fighting the Fed, but best anticipating how the Fed may move towards that 5-cut reality?
Chair Powell has been really on his front foot with regard to telling people the path of the Fed. So you got to really listen to what he's saying and how he's approaching the markets. And what he said on Friday was a very passive approach, and they're waiting to see what will happen next, and not going to overreact to a market or the sentiments from President Trump either. So you have to really kind of pay very close attention to his messaging, and I think then you will get a better decision. And ultimately, if you look at the predictability of the markets with regard to Fed rate cuts and the Fed's own inclination to predict, it's historically pretty poor. It does not reflect very well over a longer period of time. So if you're looking at a 6 months out rate cut environment, the market is usually very wrong in that regard. And we've seen that in the past. We saw that rate cuts were scheduled as high as 7 cuts at one point back in 3 years ago. Yeah. None of them happened.
So Chris, what's your single best idea for investors right now who are looking for something to do in this moment?
I think to go more towards things that are a little bit able to weather the storm, and those could be consumer staples. I really like the energy. It's particularly utility markets. Long term, they do well in a recessionary or a downturn in the economy, and I expect them to fare fairly well. So this could be a buying opportunity for those types of stocks in this environment.
All right, a sobering reminder a moment ago, Chris, that the Fed's responsibility is not the stock markets. That is not part of their dual mandate. Chris and Luis, thanks so much for taking the time here with us. Appreciate it. Coming up, everyone, Jamie Dimon warning about the impact of President Trump's tariff policy, what investors are watching as bank earnings, they kick off this week. That's next on Morning Brief.
JP Morgan Chase CEO Jamie Dimon releasing his annual shareholder letter saying President Trump's tariffs will likely boost prices on both domestic and imported goods while slowing growth. But he hopes the U.S. will see some positive benefits in the long term. Dimon, now the first Wall Street bank CEO to address the tariff policy amid the market sell-off. Joining us now with more, Devin Ryan, Citizens Director of Financial Technology Research. And Devin, all of this coming as we're heading into bank earnings, and Morgan Stanley is downgrading the entire banking sector amid recession risks looming. To what extent do you think financials are unbuyable if we are heading into a recession?
Hey, good morning, Maddie. It's obviously a complicated equation. We came into this year and there was a lot of enthusiasm, particularly for the capital markets recovery and kind of the cyclical businesses just on pro-growth, less regulation, and really just time going by where people are feeling like we're in a better moment. And now I think that is in jeopardy. When I take a step back, we were expensive coming into the year. We've now reversed kind of that whole valuation dynamic, and now we're trading at pretty actually below average multiples on our view of normalized earnings, and that's always kind of grounded us. So of course, in a recessionary environment, which I don't think is the base case in our model at this point, but in that environment, there's still some more downside in these stocks. But when you zoom out, if you can buy good businesses, depending on what your time horizon is, there are already some opportunities that we think are being created. I think it's just a matter of what your time horizon is and what you're looking to accomplish in your portfolio.
It's so interesting, Devin, because within the complex of normalized earnings, that would also rely on a few of the inputs remaining the same, which was also kind of pointed out within Jamie Dimon's shareholder letter, talking about where there is still global partnership, but sure, better trade deals that get netted out. And I think a lot of businesses have tried to figure out as well for themselves, if you did see an abnormal environment start to play out where they can't rely on some of those global partnerships because there is such a repatriation of either consumer sentiment or of some of the business efforts and thus dealings. And then you have to figure out how much of that output and productivity needs to come centrally from the U.S. How does that then put even more of a strain or reset some of the valuations to a point where we need to start thinking about valuations in an abnormal type of setting?
Sure. Well, I've done this for over 20 years. We covered, financials through the financial crisis. You had, Brexit. You had, the COVID. You had the 2022, the wars and interest rates. And every time, it's something different. And I agree. This is complicated, and you're trying to kind of update your models. You're kind of chasing your tail a bit, right, in the near term. That being said, when you do take a step back, there are underpinnings for a lot of the businesses, the companies we cover, whether it's wealth management, where people need financial advice, whether it's investment banking. You look at the private equity sector, portfolios are at the longest duration they've been at in 20 years. They're 6.7 years right now versus an average of 5.5 years. So there's a lot of tension that's been building where companies need to make strategic decisions. They need to buy other companies. They need to raise capital. That's all already been on pause for 3 years. And so absolutely, this will make things more complicated. But for companies, particularly the companies I cover that are investment banks, that are providing advice, companies are going to need advice getting through this moment. So things will take a little bit of a pause here, without a doubt. But then we will get back to an environment where I think there's going to be a lot of demand for the services of the companies that I cover.
So what are you anticipating then when it comes to earnings results this Friday in terms of net interest income and in terms of any warnings moving forward that could be a risk to NII?
Yeah, I think companies are going to have a hard time giving anything with precision, right? Yeah. We are still in the middle of this. And so I think that companies are going to be very guarded in terms of what they say that would be kind of a long-term view. Anything short-term, I think, is going to be dictated by what they're seeing in the market really, at this point in time. But I don't think you're going to get a lot of guidance on areas like net interest income, or if you do, it'll be with a kind of a broad scenario range. And so my view is earnings, I hate to say they don't matter, but right now we are in a macro market. Macro first, meaning what happens with tariffs and really the ultimate economy is what's going to drive sentiment in these stocks. And so if we get any view of stabilization, even if it doesn't help earnings in the near term, these stocks do well, and vice versa. If you start to see this trickle into the real economy and a slowdown, then like I said, there's still more downside in stocks in a recessionary scenario. But I like where we've come off of. We came into the year with valuations really at kind of record highs. We've now taken all that excess out. We're below average. So we're starting to get into more interesting areas, I think, for investors that have a longer term horizon.
Devin, what's all this mean for underwriting too for some of these banks? If you start to hear IPOs, or if you start to hear in the deal making environment that there's more hesitancy.
Yeah, well, it's already happening. So the interesting thing is, companies haven't been able to go public for really the past few years. You had 2021 was a record. The last few years are really slow. But part of that is because companies weren't ready to go public. The investors demanded that companies get to profitability and really change how they deliver results. And so what's finally happened is a lot of companies that were, I think, looking at the public markets have finally gotten their businesses to a place where they're ready. Now the markets aren't ready for them at this moment, but there's a backlog building of companies that want to get in the public market. And the reality is they're better quality companies than we've really ever seen, in my opinion, trying to come public. So it's a coiled spring. It's a matter of when, not if. The current moment's going to be tough. Companies are not able to get out into this type of market, but there are a lot of really high quality companies that are in the press that have suggested they want to come public, and we think there's a big pipeline even before what is broadly known about at this point.
Yeah, we've been able to keep tabs with some of those companies and their leaders as well here on Yahoo Finance. Devin, thanks so much for taking the time here this morning. Appreciate it.
Great seeing you.
Good to see you too. Coming up, a check on the oil markets as tensions escalate. That is next on Morning Brief. Oil prices falling sharply, briefly dipping below $60 a barrel as the trade war escalates, fueling recession fears. Our very own Ines Ferre is over at the Wi-Fi Interactive with the latest moves. Hey, Ines.
Hey, Brad. Yeah, and you have to go back to 2021 to see these types of levels that we're seeing right now, with Brent futures up around $63 per barrel, around 64 almost, but down 2.5%. Remember that oil prices last week tanked a total of 11%. You're looking at WTI that's also down to more than 2.5%. And check out these year-to-date declines that we're seeing on both WTI and Brent crude. Over the weekend, you had Saudi Arabia that has lowered the price of its flagship oil for its Asian buyers. So that also put pressure on prices as well. And last week, you had OPEC Plus, which is led by Saudi Arabia, saying that it will increase its output in May more than what the street had been anticipating. So that has put pressure on crude. You have Goldman Sachs, which just last night lowered its price target on crude for the second time in a matter of days. Now Goldman Sachs is saying that it sees Brent at $62 per barrel for an average for 2025, and it sees WTI at $58 per barrel. There was one interesting note from Citi analysts, though. They are seeing a floor on Brent prices because they're saying, look, OPEC Plus will not want prices to go below the $60 threshold, and U.S. shale will not want that as well. Remember that Trump wants the energy prices lower. He wants to bring down oil prices. They are coming down, but we'll have to see how the industry squares that off because the industry doesn't want oil prices that low. Guys.
Inez, thank you so much, as always, for bringing us your commodities reporting. Really appreciate it. We're going to get a check in on the major averages as we do head to break. Your S&P 500 currently on track if we continue to see this move to the downside to close in a bear market. Having said that, we have seen the NASDAQ paring its losses a bit this morning, though it's still off a little over 3.5%. I do want to quickly do a check on the bond market if we have it, because we are still seeing a move up in yields. If we continue to see that curve steepener, what is that going to mean in terms of how the market is pricing policy to come from the Federal Reserve? The Fed not necessarily interested in fixing a policy mistake from the White House right now. All right, that's going to do it for the morning brief. You can join me in the next hour for more analysis on Catalyst, and Brad will have you at 11 a.m. Eastern for Wealth. Stick around.